Right. So I give actually Citi more credence in their view than I do the others who have been saying buy every dip all the way down as NASDAQ stocks have corrected 50%. They went back to overweight. You can't pick bottoms, you can't pick tops. So it's probably a reasonable point of entry. However, I've got flexibility to take it a little lower before I start buying stocks. I just don't think we're there yet. You're still at a premium to the 10-year forward multiple on the S&P, and it's got to correct because of everything that's going on. And the Fed, to Josh's point, I thought the Fed was in a tough position before because of inflation and the fact that a few rate hikes weren't going to take it down. They're in an even tougher point right now because inflation is accelerated given oil prices. And as I look at the research daily rundowns I get from firms across the street, I still see many, many more lowering of estimates this year and next year than I see increases. And I'm talking about the decreases in estimates versus the increases that we saw over the last year with earnings up 30% are just overshadowing that. So we're in a period where multiples have to contract. I do not think that we're there yet in the contraction, so I'm waiting. I just think it's very tough. I still look at Ford, for example. I want to buy Ford, but I'm looking at the multiple it's trading at, and guess what? It's still a very capital-intensive business, and still too high.
All right, well,
so
then the natural question is, what's the number? I mean, if you're waiting for the multiple to contract enough for you to think that stocks are then attractive enough, what's the number? What should people look out for?
So I, in a perfect world, I'd like to see the PE on the market trade down to about 14 times, 13 times, because I believe it'll overshoot. However, I'm not going to wait for that. It's as much a function of the number as it is events. And I really need to see inflation come down a little bit. So for all the bulls talking about, and we heard Jim say it yesterday, I have tremendous respect for Jim, that, hey, the market knows all this. Well, the market also knows that the war in Ukraine and Russia is going to end at some point. What the market doesn't know is how consumers and companies are going to respond to these massive input increases. And I think that is yet to come. So that's why I'm being patient.
Okay,
so it's not just a number, Scott, it's events. Also.
I understand. But you referenced Jim Lebenthal on this call that he made yesterday. Remember, we had Tom Lee on yesterday, too, and you'll hear from him in just a second, at least what he said yesterday. But now, since you teed it up, I want to hear from Jim Lebenthal right now, what he told us yesterday, why he seems to be growing more bullish almost by the day, and why it's going to continue for the next couple of weeks. Here he is.
I do feel confident that conflict will become clearer, the outcome one way or the other, over the next 2 weeks. And that sets the stage for the economic strength, particularly in the U.S., to shine through. Accordingly, I have been adding to stocks over the last 2 weeks. You know, I raised cash earlier in the year. I've cut that cash level down in half to about 5% by buying cyclical and reopenings, whether it's the financials this week or Wynn and Paramount last week when you were out sick. I think you've got 2 more weeks to use your dry powder. And you know what? You know what, Scott? It's time to dust off the all-in moniker, because in 2 weeks I'm going to be wearing it again.